the first thing I need to do is sort of map myself on a spectrum. You're an investor, you want to invest in ESG. Why do you want to invest in ESG? Do you want to do it because on one side, you want to improve your investment returns? Or on the other side, do you want to improve the world? So once you kind of know that, and to clarify a little bit, when you're talking about improving your returns, you believe that ESG is going to reduce risk and enhance your return. If you want to improve the world, you want your investments to do no harm or to even make the world a better place. And there is a spectrum there. So once you've understood where you fall on that spectrum, the Canadian Investment Fund Standards Committee recently launched a responsible investment identification framework, then that would be the next step.
Hello, everyone. Welcome back to Strictly Money, where finance and your prosperity meet. I'm your host, Sejal Patel. Today, we are diving into the world of ESG investing with my special guest, Danielle LeClair of Morningstar Canada. Now, Danielle is the Director of Manager Research, and she played a key role in a research report that was released on the sustainable investing landscape in Canada. As you might know, a lot of investors are drawn to sustainable investing because they want to align their values to investment choices. But the area is not without its key challenges. So we are going to dive into the trends and also answer your burning questions, like how do you even pick a sustainable fund? And is the performance actually better than non-sustainable funds? Hi, Danielle. Great to have you on. How have you been?
Not too bad. How about you?
I've been well, keeping busy, and I know you have as well.
Absolutely, for sure.
Yeah. I'm so glad you're here because I wanted to cover ESG investing. This is, Danielle, a question that I get asked all the time from women in my online financial program. They're very curious about ESG investing and sustainable investments. And this is perfect timing because I know Morningstar Canada, and you've been heavily involved in this, has just released a recent report on sustainable investing in the landscape in Canada. So I was looking at this report, a lot of interesting trends, and I thought I'd kick it off with the first one. Sustainable funds continues to be a priority asset for both asset managers and investors. Doesn't really surprise me, but maybe we can just unpack this and what you're seeing.
Yeah, and I think from that angle, we see it. What I meant by that was there's two things we're seeing. We're seeing positive flows and we're seeing fund launches. So to me, that's the interest from investors and the response from the asset managers. Chicken and the egg, which is coming first, TBD, I guess. But that is something that we're seeing. And we did see continued positive flows into the sustainable fund space in Canada, which was actually interesting because in the US, we saw outflows in sustainable funds. So a little bit of difference there that we would have seen between the two markets, which I think it's really just a reflection of the interest for Canadian investors in these types of products.
Yeah, that's really interesting. Now, what I found, what was interesting is inflows, $2 billion last year. It did shrink a little bit, but it was still better than conventional Canadian like open funds and ETFs, which was about 1.6 billion. But those were outflows. Am I correct?
Yeah, exactly. And I think that some of that is just general macro environment, a little bit outside of my wheelhouse, but we have seen a lot of inflows into things like GICs. So are investors sort of moving their money outside of mutual fund and ETFs in general? I think there's a little bit of TBD on that. But in such an environment where you've got higher investment or higher rates and higher yields available, I think investors are kind of taking a holistic look at their portfolio and seeing what other options they have available.
Yeah, I can tell you that I have seen that. I've been having some conversations and they have seen, now I don't know all the details, Danielle, but that was definitely, I think, part of the equation is people were saying, hey, you know what, I can get 5% in GICs right now. So why don't I look at rebalancing my portfolio and putting in something safer. I guess because there is still a lot of economic uncertainty and people feel it. Um, I want to talk about the other piece that you mentioned in that the asset managers making it a priority. 78 new sustainable funds launched. That's a lot.
It is a lot. And I think that that's just, as the industry grows, as things like, investor expectations are becoming a little bit more clear, asset managers are really taking the time to build these products, more thoughtfully, I guess, and more to adhere to what the investors are actually looking at. So it was a pretty big number. I was a little bit surprised, I guess, kind of going into it with this thought of investors are moving out of mutual funds and ETFs. But, I think that's a really a strong number that we saw last year.
But as part of it, I thought what was also interesting, Danielle, is like 93% of those fund launches were actively managed. So I guess less on the ETF side. Is it because this requires more active strategy and more active management, or is there another reason behind that?
So maybe just two things. So one, I think there might be a little bit of a common misconception that ETFs mean passive investing. If I kind of think about it even more broadly, we've seen a lot of growth in what's called actively managed ETFs. And so I think because of that fact, I was even more surprised that we didn't see more of the ETF vehicles being launched. Because really, I say vehicles, and what I mean is mutual fund or ETF, commonly referred to as vehicles. That doesn't really impact how the investment manager is making decisions. But when it comes to sustainable investing, if you think about actively managed versus passively managed tends to follow some form of rules-based methodology. They might track an index. And so really the manager is not really making any kind of active decisions. There's some benefits to that. It tends to result in maybe more market-like exposure that an investor would be looking for. But when it comes to ESG, rules-based, things that are based off of data, we're still seeing a lot of developments when it comes to data. And so the actively managed side of the equation allows investment managers to really dig into a company, to dig into a country and understand what the underlying drivers of these things are that are relevant for ESG risks and opportunities. I remember talking to a manager once who said, I invest in small caps and I can't use ESG data because, these are smaller companies. They don't have the resources to satisfy a lot of the data requirements. And so this manager is able to look at these companies on their own with their own metrics to really understand that. So I don't think there's a better or worse approach to it, but there is just an understanding that there are pretty notable differences between the two.
I'll tell you what I thought was interesting when we look at fees, right? Because investors are so fee sensitive. And typically, as you said, with active management and screening, you would think that the MERs or the management expense ratios would be a lot higher. You didn't see that though, did you?
No, and to be honest, I think it's the last slide in our deck, but it was one of the ones that surprised me the most. Because you would have thought that ESG would have required more work, I guess, therefore more fees. But we didn't see that. And in fact, one of the biggest differences that we saw was on the ETF side, where sustainable funds were somewhere around 20 basis points cheaper than traditional ETFs. And so I kind of took a walk after I saw that number and did some thinking about it. And really what I was able to sort of walk myself through, I guess, is if you think about conventional funds, this is a really established place. You've got a lot of actively managed things in there. You've got a lot of different types of asset classes that are a little bit more complex and therefore have a little bit more of a premium on the investment fund costs. Whereas sustainable funds, because they are newer, because we are seeing a push towards more lower fee vehicles, my suspicion is that because of that, you are seeing kind of lower fees, or in the case of ETFs, in the case of kind of your traditional mutual funds, they're a lot more just in line. So it was a surprise for me. But I think that's where I landed on the fact that ESG funds are a little bit more new and maybe benefiting from some of the newer market trends when it comes to fees.
What I also noticed, and I guess what I appreciated, is that all the different offerings that come with these sustainable investing, because it's not just equities that people have exposure to, and you're seeing a lot more in the fixed income space and alternatives as well. So it seems like there's something for anyone who is interested in ESG or sustainable investing, but is also looking at their asset allocation or portfolio management.
Yeah, exactly. I refer to the equity funds as kind of the OGs when it comes to sustainable investing. Or, they've been around for a while. And I think that just goes down to the fact that, understanding ESG risks and opportunities and the drivers of these risks and opportunities has historically just been easier to do on a company or a stock, where you can kind of sit with management. There's reporting requirements that are a little bit more clear. Whereas some of these other asset classes are just more complex. And again, that just kind of goes, the fact that we're seeing this diversity goes into the kind of maturity that we're seeing in the industry as well, and the developments on things like understanding the conversations behind, with the investment managers and the securities that they're investing in, just really getting a better understanding of that. And in fact, last year, fixed income funds saw a lot of assets and saw a lot of launches. And so I think you're right. We're just seeing kind of the universe becoming more robust.
Yeah, which is great to see. Danielle, we're going to take a quick break and hear from our sponsors, BMO ETFs. And when we come back, we'll address some of the burning questions. And I think the biggest one is, how do you even pick a sustainable fund? So we'll take a break and we'll be right back. Welcome back to Strictly Money. I'm here with Danielle LeClair of Morningstar Canada. Danielle, I think what most people really want to know, and especially because there's just so many funds to pick from, how do you start?
Yeah, it's a bit of a matrix. So let's take a step back. As an investor, so if I'm an investor and I've decided I want to invest in an ESG or responsible investing strategy, the first thing I need to do is sort of map myself on a spectrum. And I will be honest, I'm kind of taking this concept from one of my colleagues who wrote a piece about this a few years ago, but I think it's really clearly articulated, where you're an investor and you want to invest in ESG. Why do you want to invest in ESG? Do you want to do it because on one side, you want to improve your investment returns, or on the other side, do you want to improve the world? So once you kind of know that, and to clarify a little bit, when you're talking about improving your returns, you believe that ESG is going to reduce risk and enhance your returns. If you want to improve the world, you want your investments to do no harm or to even make the world a better place. And there is a spectrum there. So once you've understood where you fall on that spectrum, the Canadian Investment Fund Standards Committee recently launched a responsible investment identification framework, then that would be the next step. So let's just say you are the investor that wants to improve your investments. Within the framework that was developed, you can look at things like ESG exclusions, ESG integration and evaluation, or ESG best in class. And these are the type of strategies that incorporate ESG into the investment process, but they're not necessarily doing so at the expense of returns. There's an element of kind of balancing between the two. Whereas if you're looking to improve the world, you might want to look at things that are labeled ESG thematic, investing specifically in like a climate fund, for example, or a water fund or a women in leadership fund. There's also ESG engagement and stewardship. So these are strategies that the investment teams are actively working with the companies in the countries where they own securities to improve the results from an ESG perspective. And then lastly, maybe the one that people are more familiar with is impact funds. And those ones really, the way that the framework is built is really a higher bar where investment managers have to actually state what their intent is, and they have to report measurable impacts. So understanding that spectrum, what's your motivation for going into ESG investing? and then using this framework to sort of map or at least give you a sense of the strategies that would best complement what you're looking for. I think that's the best approach.
You mentioned, Danielle, this framework, and this is the Canadian Investment Fund Standard Committee. And so they have this framework. Is that a good place? Like, I understand that they have flags. Maybe you can explain this one. And I'm putting this in context because the question that I know you get and I get is, how do we know that they're really sustainable? You know, this whole thing around greenwashing. And so I'm wondering if this committee or this framework addresses that.
Yeah. So I guess conveniently, I'm the chair of that committee, so I have insider knowledge on how it's done.
Okay, great.
But yeah. So what we did there was we took the list of funds. We developed a list of funds that either we thought were ESG or were expressively labeled as such, and we went through, I want to say, somewhere in the range of 300 to 400 prospectuses. And prospectuses are the legal documents behind a mutual fund or ETF that outlines what the investment objectives and the investment implication or investment strategies, is for each one of those funds. And so the framework requires that an investment manager state in the investment objectives that there is an ESG approach incorporated into the fund, and then requires that within the investment strategies of that document, that approach is elaborated on so that you get the clarity and the understanding behind what they're actually trying to do. So there was no kind of metric behind this. We went through it. There's a committee. We all kind of, talked about it and agreed. And that's where those flags or identifiers were awarded. Something that I should say is that we declined to add some identifiers to investment strategies that wanted or were looking for those, because we felt that either the language was very vague or that it was missing completely. So, I think that's something that investors can have confidence in, at least that there is a group behind what's going on there. But then just as an aside, when we decline those, we actively involve the asset managers. We give them a rationale. In a lot of cases, they look to have discussions with us to kind of better understand what we're looking for and how to communicate it. So, that is a unique thing in Canada. It's a disclosures-based framework. So I do think Canadian investors have a little bit of an advantage by having that available to them.
That's really interesting. So anything that you think investors should be aware of or questions they should ask?
I think when it comes to, in particular, those strategies that would fall on what I would say the improve the world side, is really looking that they're actually, communicating that they're doing what you think they're doing. Just because a fund is labeled women in leadership, you might interpret that a little bit differently than what the stated investment objective is. And so I would say for investors, take a look at those prospectuses. Yes, they're legal documents. They are big. But it's worth taking a look at to just better understand it. And a lot of these strategies, they do have marketing available. They do have their portfolio managers on, webinars or things like that. So I would say, make sure that you're in contact with some of these resources when you're investing in ESG strategies, just so that your understandings are aligned. Because I think that's the intent of the framework, to help align, understandings. And I do think it's a really big step forward. But for investors, particularly if you're new to the space, something like that would be an extra due diligence that I would recommend.
Yeah. And prospectuses, we know, it has so much information and it lays out the criteria. So a good place to start. Danielle, you touched on performance. So let's talk about performance. Are ESG or SI investments, or RI investments better?
I always kind of, I want to caveat everything when we talk about performance, because the truth is that any investment fund is going to outperform and underperform. And the way that I describe, what you kind of want to do as an investor is understand what I call the personality of the mutual fund or ETF. And so what that means is understanding what those cycles look like, and does the investment strategy sort of follow that? For example, if it's, growth is outperforming, if you own a growth fund, you want to see that growth fund outperforming, right? And so when it comes to sustainable funds, we saw some pretty good results last year from an investment performance perspective, but they are still lagging behind conventional funds on a 3 and 5 year basis. I don't think that means they're any better or any worse, but what I do think that last year really helped us was to fill in some of that understanding of the personality of sustainable investments. Energy, for example, had been doing really well in years prior. A lot of sustainable investment funds are underweight or don't have exposure to energy. So that could be a reason for why they were underperforming. last year energy didn't do as well as it had in previous years, that could be something that boosted returns for sustainable investments. But I would still say that we are still kind of rounding out the understanding of what to expect from sustainable funds.
Yeah. And an interesting point, right? Because you do have to put that all in context. And we know historic performance does not predict future performance. So I guess it's a wait and see and see if this trend continues. Danielle, let's talk about some of the ones, some of the type of funds or fund families that are leading in this space, because I thought this was interesting. Mackenzie Green Chip Global Environment All Cap Fund. So this took the crown as Canada's largest active sustainable fund, $2.9 billion in assets.
Yeah, that fund, it's kind of been a mainstay in the top. And in fact, I was sort of looking over the last few years, and it has been top 1, 2, or 3 funds, since inception, basically, when it comes to sustainable products. So it's definitely been, a good fund come from a performance perspective for Mackenzie in terms of, gaining assets for them. I think one of the things that they've started to do with that strategy is we kind of talked about different asset classes. They've expanded that strategy a little bit. There's now a balanced version, so multi-asset. So there's a fixed income component to it. They also launched some US dollar denominated versions of the strategy. So really kind of expanding on that core component or core strategy that they have. I think that's a pretty good sign. Mackenzie is also interesting because they are, I believe, the first movers in terms of offering retail investors an explicit green bonds fund, and one of, if not the only, investment manager that's offered Sharia compliant products to the retail investor. And under the Canadian Investment Fund Standard Committee framework, Sharia compliant is classified as responsible investing under the exclusionary criteria. So Mackenzie really does have, they've got this stronghold with the green chip strategies, but they do have a lot of diversification in their offerings as well that I think is really it.
Yeah, and I should say I know that because I am on Mackenzie's IRC board, the independent review board. So I thought this was interesting. The other one is National Bank. That's a favorite.
So National Bank stood out in a big way last year. And I have a couple of interesting observations there. So the first one is they brought in over 50% of all inflows when it comes to sustainable funds last year. And across a variety of strategies, but one in particular, their Sustainable Canadian Bond Fund, which comes in a mutual fund and an ETF structure. They really, above and beyond, they brought in a bunch of the assets there. And something that I think is explicitly interesting there is that fund is actually included in National Bank's non-ESG balanced funds. So I think that's an observation around a trend that we're seeing where ESG funds do have a home in quote unquote non-ESG strategies. So I think that's something that investors should just kind of take and kind of see, just really kind of see that as validation that ESG risks and opportunities really are things that should be considered along financial opportunities. And in fact, I know we're talking about National Bank, but in 2023, we looked at newly launched funds, and the fund that gathered the most assets in 2023 that was launched in July of 2023 was the Sun Life Acadian International Equity Fund, which is also included in their non-ESG balanced funds. So again, I think there's a little bit of a trend there emerging that we're seeing.
Oh, that's really interesting. So I guess you would find that in the fund fact sheets. If you look at the top 10 holdings, maybe you would see it if it's a significant portion.
Yeah, exactly. That's where you would see those. And even if it was, I believe they have to release full holdings kind of on an annual basis. So you can kind of see even if it's a smaller position. But I think both of those cases, you would see them in the top 10. So interesting that, and balanced funds in Canada are the largest asset class. So the more that we're seeing some of this these strategies come available, and the more they come into balanced funds, I think that's something that we'll see further.
I did not know that. So that's a great, interesting trend. And then BMO ETFs, they have one, the BMO MSCI USA ESG Leaders ETF. Ticker is ESGY.
That one stood out because of the outflows. Now, I want to just take a little bit of a step back. So BMO is among the largest ETF providers in Canada. They're also among the largest ETF providers for sustainable funds in Canada. they have 28 sustainable funds, and 12 of those are ETFs, with 11 of them being passively managed products. One of them being this U.S. one that you were mentioning, and it was among the top funds in outflow position in 2023. I think that one is more the result of the macro environment rather than anything that you would think is wrong with the fund or out of favor. When you're seeing broadly that investors are shifting into fixed income strategies, that often comes at the expense of equities, and the U.S. equity market is the largest equity market. So it kind of makes sense. And just to sort of solidify that, the fund that saw the largest outflows in the U.S. was the iShares ESG Aware MSCI USA ETF. So there's a commonality there that, like a index tracking ETF with U.S. equity exposure was the largest in outflows there as well.
Yeah. And you were saying that, there's a big difference between what's happening south of the border and their view on ESG investing compared to Canada. Would make sense.
Yeah. I mean, ESG in the US is a little bit more of a political topic than it is in Canada. So I think that probably was driving their general outflows. But this one in particular, again, I would just kind of attribute it to the macro trends.
Danielle, what are some of the themes then and trends that you're looking for in the next year or two?
Well, I kind of alluded to one or really went into it because I'm kind of excited about it, but it's the balanced fund, the impact of balanced funds on Canadian sustainable fund flows. So I think we're going to see a lot more of these building blocks or the individual asset class for sustainable funds showing up in balanced products. I think we're also going to see a lot more balanced products that are going to be launched with an ESG specific focus. Which kind of leads into my second trend that I think this is, again, a broader trend that we see alternatives as a prime focus for asset managers. I think that reigns true for sustainable products as well. So seeing a lot of product development. And in fact, already in 2024, NEI Investments launched a sustainable long short strategy. So that kind of leans into the idea that alternatives is going to become more of a fruitful hunting ground for investors on that ESG side. And then the last one is kind of what we started the conversation talking about is the lack of ETF options. Again, from a conventional fund standpoint, asset managers are really focused on launching ETFs and actively managed ETFs. And I think that's a trend that we're going to see trickle through to sustainable investments as well.
Danielle, do you know where Canada sits in terms of sort of ESG investing compared to other markets around the world? And because you and I talked about, before we started recording this, we were talking about sort of that home bias and a lot of Canadians have that. So I'm just wondering, where else they would get exposure and what other markets are doing well in this space?
It's hard to ignore Europe when it comes to this. They're definitely further along, I would say. And what I mean by that is, they're further along from a regulatory perspective. And so there's actually regulatory requirements in Europe to kind of identify your ESG-ness, for lack of a better term, and your exposure to various ESG things. So I would say Europe is definitely a leader in the space. Australia is also pretty advanced in terms of what they're looking at. And we can actually see conventional products, for example, available in Canada and Australia, where the Australian one just naturally excludes certain areas. And so I think that's kind of just the reflection of where ESG comes. So I don't think, I would kind of say Canada is ahead of the US because of maybe the more open-minded approach to how we think about ESG, but we're probably still behind some of the markets overseas.
Okay. Great to know, Danielle. I really appreciate your time today. And for those of you who are interested in reading the report, I will include a link in the show notes. Now, Danielle, before I let you go, I love asking my guests 3 rapid fire questions on their view on money and personal finance to really try to make this a little bit more accessible to people and approachable. So are you ready to play?
I am more than ready. Let's do this.
Okay. What is the best financial advice you've ever received?
I would say start early. Even if you can only put $25 into an RRSP on a monthly basis, getting used to that cycle of saving, that habit, I think it's something to get started early with.
That's a good one. When did you start investing?
So I would call it like a kind of a late bloomer when it came to that. I wasn't exposed to personal finance early on. So I was probably in my mid-20s. And I did start with $25 on our RSP. So that's where that advice comes from.
Yeah. Well, I mean, it's better than nothing. And it's funny that you say that because I often get a lot of people thinking that they need a lot of money to get investing and to actually build wealth. And I keep telling them it's not, it's time in the market. It's when you start that's actually because that's where you allow the power of compounding to work, right? And it feels like nothing's happening in the first maybe 10 years. And then you see that exponential growth, right? So patience is everything. So that's a good one, Danielle. What is the worst financial advice you've received?
Okay, this is going to sound a little bit like a contradiction, but to save every penny. And what I mean by that is I think when you're building a financial plan, we focus on the saving part, but we don't focus enough on the living part. Like I'm going on vacation next week. I'm very excited about it. And I think that's something that's been built into my financial plan to be able to enjoy kind of in the moment as well. So I would think that, when it comes to financial planning, creating that balance of savings, but also living today as well.
I think that's a really good one. And I think, when you do have a financial plan, you know what you're working with. So it's less stress. And I find that when people get stressed, it's because they're making these decisions in isolation. So they stress out. They want to go on vacation, but they stress out because they're not sure if they have enough money without actually doing the numbers, right? So that's again, a very good one. If there is one message you could give to our viewers or listeners that you think would help them build financial well-being, what would it be?
Ask questions. I think even early on in my career in financial services, I was maybe intimidated to ask questions. And really, that's how you learn. That's how you gauge, what your own financial objectives are, because it can be intimidating not only to plan it, but to figure out like what you want. And so I think that that's the way that you really build the foundation that's required for kind of future planning. Is just ask questions.
I love that one. Great way to end the show. Danielle, thanks so much for coming on.
Thanks for having me anytime.
Danielle LeClair of Morningstar Canada. Well, that wraps up this episode of Strictly Money. Don't forget to subscribe and comment below if you like it or leave a review. And if you know of someone who might be interested in ESG investing, don't forget to share. We'll see you back here next week. Until then, stay well, stay wise, and stay wealthy.